In March 2026, Nike moved forward with about $300 million in restructuring charges from its headquarters in Beaverton, Oregon, and most of that expense came from severance tied to its turnaround plan under new Chief Executive Officer Elliott Hill, who replaced John Donahoe in October 2024. Approval came on February 27, 2026, and the company said most of the charge would land in the third quarter of fiscal 2026. This was part of a longer pattern, not a one-off step, because Nike had already cut more than 1,600 jobs in February 2024 and another 775 U.S. positions in January 2026. It solved short-term cost pressure, but it created a deeper reliance on cuts while demand still looked uncertain. Late 2023 is where the reasoning starts to come into focus, because that was when Nike cut its full-year sales outlook to about 1% growth, after earlier pointing to mid-single-digit growth. Executives blamed cautious consumer spending, weaker online demand, and heavier promotions, while wholesale orders also softened as retail partners pulled back. Around that same period, Nike put a $2 billion savings plan in place over 3 years, built around tighter supply chain changes, fewer layers of management, and more automation, which meant the company was already preparing to trim costs before the March 2026 charge arrived. If this kind of analysis is useful, subscribe. What followed made that direction easier to see. The basic idea behind the move was simple enough. Demand had cooled, costs were rising, and Nike needed room to spend again in the areas that still looked capable of driving growth. One retail analyst explained that Nike wanted to invest more in running to win back market share from competitors like Hoka, On Running, New Balance, and Adidas. That meant those new costs had to be offset somewhere else. And the company also knew its earlier direct-to-consumer push had failed to deliver the results it wanted. Direct-to-consumer, often shortened to DTC, means selling more through a company's own stores and online channels, instead of leaning as heavily on outside retailers. By mid-2024, Nike was already moving back toward wholesale partnerships as newer brands kept taking shelf space and consumer attention. February 27, 2026, was the point where that thinking turned into action. Management approved organizational changes expected to create about $300 million in pre-tax charges for the 9 months ending February 28, 2026. Nearly all of that amount was tied to employee severance. Nike described the move as a way to operate more efficiently and more profitably, while still paying for efforts to reignite growth, including investments in its Jordan brand subsidiary. Rather than keeping headcount in place while relying only on slower savings or heavier product investment, the company chose layoffs and restructuring charges to move faster. The SEC 8K filing said the estimate rested on assumptions, could change materially, and might be followed by additional charges, which meant even Nike was signaling that the final number might shift. That choice made sense because Nike was trying to fix margins and demand at the same time, and those two problems were pressing on the business together. Reuters reported in March 2026 that Chief Executive Officer Elliott Hill wanted to contain what he called margin bleed, while also refreshing the product mix to lift sales. And that matched the earlier savings plan from December 2023, when Nike had already outlined $400 million to $450 million in pre-tax restructuring charges, again tied mostly to severance. By the time March 2026 arrived, this was not some brand new playbook being invented in a rush. Management was extending an approach it had already accepted, because payroll and structure looked like the fastest places to free up room. Product and marketing plans made the move look even more practical. Early 2025 brought launches including the Pegasus Pro and Vomero 18, featuring Nike's ZoomX foam technology, and management said those shoes gave Nike breathing room after several weak quarters. The company also returned to the Super Bowl for the first time in 27 years and announced a women's apparel partnership with Skims, the brand founded by Kim Kardashian, positioning Nike against competitors like Lululemon. Those steps required money and attention, which meant Nike was trying to fund a fresh push at the same time it was still clearing older inventory through promotions, and the chief financial officer said that cleanup would take several quarters. The result was a company trying to do two hard things at once: clear yesterday's product while paying for tomorrow's recovery. The next hard number was 41.5%. Pressure showed up clearly in the numbers. In the quarter ended February 28, 2025, gross margin fell 330 basis points to 41.5%, and Nike tied that drop to higher discounts, excess outdated inventory, and higher product costs. A basis point is 1/100th of a percentage point, so 330 basis points equals a decline of 3.3 percentage points, and that gives a clearer sense of how much margin had slipped. By the quarter ended November 30th, 2024, inventory stood at about $8 billion, which meant a huge amount of product still needed to move. Early 2025 figures also showed app downloads down 35%, while physical store traffic fell 11%. Cost control was only part of the problem. Consumer interest had weakened too. Outside pressure kept tightening the squeeze. In December 2025, Nike reported that sales in China had fallen 17%, the sixth straight quarterly drop there, and the company also warned that U.S. tariffs on Southeast Asian production would cost about $1.05 billion in 2025. Net income for the quarter ended November 30th, 2025, fell 32% from a year earlier. Gross margin dropped another 300 basis points, and Nike expected a further decline of 175 to 225 basis points in the following quarter. None of that sat inside management's control, which meant the restructuring decision was not only about weak demand or promotions, but also about rising external pressure at the same time. The trade-off became clearer in 2025. By 2025, the story had changed shape. App downloads were down 35%, store traffic had fallen 11%, and Nike was still discounting older products heavily, with management saying that inventory clearance would take several quarters to finish. A Zacks analyst said the turnaround was still costing real money, and that line fit the moment because Foot Locker, where Nike products accounted for about 60% of the assortment, also warned that promotional pressure tied to Nike discounts would hurt its own margins. Here is where the trade-off becomes easier to track, because Nike could lower its own cost base and simplify parts of the company, yet those same discount-driven decisions were starting to put stress on retail partners too. The savings were visible. The pressure was spreading. Market share showed the same problem from a different side. At Dick's Sporting Goods, Nike footwear share dropped from about 39% in January 2024 to 32% by May 2024, while On rose from 8% to 12%, and Hoka climbed from 8% to 13%, as these brands and others like Adidas and New Balance gained ground in the running category. By June 2024, at least 7 analysts had cut price targets because they expected more share loss to those newer brands. Cost cuts can remove expense, but the problem was that they could not produce the next major product franchise on their own, and a Morningstar analyst said Nike needed a whole new family of products worth billions in sales, rather than 1 or 2 fresh styles. Nike became leaner, which meant the income statement could get some relief, but rivals kept gaining ground where customers were making new choices. The next number was 19%. The point of no return did not arrive as one dramatic event. It showed up when cost cuts started to risk becoming the main answer. even though the brand still needed stronger product momentum. By early 2025, Nike shares were down about 19% from September 2024, when the new CEO took over. Analysts expected revenue to fall about 11.5% in the third quarter of fiscal 2025, the steepest decline since fiscal 2020. High inventory remained in place, promotions were still running, and wholesale relationships were still being rebuilt, which meant management was no longer dealing with one isolated problem, but several at once. When those pressures pile up together, execution gets harder fast. The lesson sits inside the trade-off itself. Nike's decision matched the facts management had in front of it, including slower sales growth, cautious consumers, $8 billion in inventory, falling margins, tariff pressure, and the need to fund new products and stronger retail partnerships. Yet those cuts could only buy time and flexibility rather than restore demand on their own. They lowered near-term expense and reduced complexity, but they did not rebuild momentum by themselves, and that is the difference between a rational move and a complete fix. We can see why the decision looked reasonable in March 2026, and we can also see why the cost went beyond the charge itself. Reasonable at the time, costly in the end. Subscribe for more decisions that made sense at the time.